Luckin Coffee, currently China's largest coffee chain with over 9,000 stores, faced a major setback in 2020 when a revenue fabrication scandal led to a 97% drop in share prices and bankruptcy. However, within 3 years, Luckin not only survived but also became profitable, surpassing Starbucks as the leading coffee chain in China. The company's turnaround can be attributed to its app-centric business model, emphasizing mobile orders and payment, coupled with a focus on self-pickup or delivery to reduce costs. This strategy allowed Luckin to open smaller, more cost-efficient stores and offer high-quality, affordable, and convenient coffee, distinguishing itself from traditional competitors like Starbucks. Luckin faced substantial losses because its business model relied on attracting customers through extremely low prices rather than quality coffee. The company offered free coffee promotions for first-time customers and provided existing customers with discounts of up to 80%, resulting in an average price for an Americano at around $1.30 compared to $4.50 at Starbucks. This pricing strategy led to a surge in customers, but failed to generate sufficient revenue to cover costs. About half of Luckin's revenue went towards purchasing raw materials like coffee beans, milk, and cups, while the remaining half covered rent, labor expenses, and other undisclosed costs, such as sales and marketing, research and development, and third-party delivery fees. Consequently, Luckin's net income margin was significantly negative, reaching 193% in 2018, meaning they spent $3 to sell $1 worth of coffee. Even after going public in 2019, their net income margin remained below 100%. Luckin justified this by claiming it was part of their loss leader strategy, aiming to rapidly acquire customers by offering coffee at unprofitable prices. Luckin initially pursued a loss leader strategy to attract customers with low coffee prices, aiming to hook them and eventually turn a profit by raising prices. However, the majority of customers were drawn to the cheap prices rather than the coffee's taste. When Luckin increased prices in 2019, many price-driven customers stopped buying, leading to a sales decline. To mask the financial struggles, management fabricated sales figures through accounting fraud. After the fraud was exposed, new leadership successfully turned the company around in 3 years. The key components of this turnaround involved cost reduction and revenue growth. On the cost side, Luckin optimized its business by halting aggressive store expansion, closing underperforming stores, discontinuing unprofitable side businesses, and significantly reducing spending on sales and marketing by 60%. These measures led to a shift from reckless expansion to store optimization, resulting in a profitable venture within the analyzed period. Luckin Coffee's strategic moves in 2020 aimed at improving financial health involved reducing consumer discounts and raising prices, leading to a decline in sales volume as customers turned to other coffee chains. However, achieving profitability required more than cost-cutting. It involved a creative approach to increasing revenue. Luckin's remarkable revenue growth, even during store closures in 2020, was driven by 3 key drivers. The first driver was product innovation, exemplified by the success of the brown sugar boba latte, introduced in 2019. This success prompted significant investment in research and development, resulting in a series of innovative coffee beverages that blended coffee with unconventional ingredients, appealing to a broader customer base beyond traditional coffee drinkers. The second driver was Luckin's successful introduction of innovative and highly demanded beverages, enabling them to raise prices while increasing sales volume. New releases like the newer latte and coconut milk latte became bestsellers, with the latter even becoming the most sold coffee drink on China's largest food delivery platform in 2022. This strategy involved introducing new bestsellers at gradually increasing prices, with the latest offering, a green tea-flavored latte in 2023, priced higher than its predecessor. The third key driver for Luckin's growth was effective marketing, particularly targeting young consumers. The shift from performance ads to brand advertising in 2021, associating the brand with professionalism, youth, fashion, and wellness, contributed to surpassing Starbucks as the preferred coffee brand among the younger generation. Luckin's agility in adapting to consumer trends, successful marketing, and the implementation of the franchising business model, combining company-operated and franchise stores, further propelled its growth. Franchising, in particular, saw a significant increase, with revenue from franchising constituting 23% of the total revenue in 2022. Luckin's success in franchising is attributed to the popularity of innovative coffee drinks, boosting store-level economics and attracting franchisees. Unconventional franchising terms, such as no upfront fees or annual franchise fees, and charging royalties based on gross profit rather than gross merchandise value, contribute to the success. This unique approach minimizes losses for franchisees, with an average payback period of 13-14 months, below the industry average of 18-24 months. Luckin's franchise program has significantly contributed to its profitability and growth, with a shortened payback period attracting franchisees. In contrast, Starbucks has maintained full control over its stores in China, believing it will become their largest market. Despite a plan to open 9,000 stores by 2025, Starbucks lags behind Luckin's rapid expansion, particularly in lower-tier cities, where Starbucks' 860 stores are overshadowed by Luckin's 2,500 stores. The differing strategies have allowed Luckin to dominate the lower-tier cities, with franchise stores representing a third of its total. Luckin's success in franchising ultimately propelled it to overtake Starbucks as the largest coffee chain in China. The zero-COVID policy in China had varied effects on the two companies, with Starbucks' sit-down experience disrupted, while Luckin's self-pickup and delivery model thrived, especially in locations like office buildings and school campuses. During the pandemic, Luckin consistently outperformed Starbucks in same-store sales growth. In 2022, amid a surge in COVID-19 cases and a lockdown in Shanghai, Starbucks reported a -44% decline in sales compared to the previous year, whereas Luckin continued to perform well. These factors contributed to Luckin's rise and Starbucks' challenges in maintaining growth and relevance in the Chinese market. Luckin Coffee's remarkable recovery showcases how a seemingly doomed business can rapidly transform itself. Although Luckin initially benefited from favorable circumstances, such as successful product R&D and the pandemic, attributing its success solely to luck would be a mistake. The new management's focus on building solid business fundamentals, effective marketing campaigns, and the strategic decision to embrace franchising played crucial roles in this turnaround. The story of Luckin serves as a powerful reminder that, in business, the right team and a bit of luck can lead to extraordinary outcomes. Luckin's ability to overcome scandals, address its business issues, and surpass a dominant brand like Starbucks within a few short years highlights the potential for significant change with the right combination of factors.